Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Royal Bank topped income and revenue estimates in its latest quarter, and it's hovering around record territory right now. Canada's biggest lender delivered strong results in its capital markets, wealth management divisions, and personal and commercial banking. The U.S. capital markets franchise accounting for more than half of the unit's revenues. The firm also boosted its quarterly dividend by 6%. And National Bank of Canada also beating analysts' estimates on net income and revenue in its fourth quarter. Montreal-based lender also posted better than expected results at its capital markets unit. This is a resurgence for that division after it missed forecasts in the previous quarter. The firm is set to take over Laurentian Bank's retail and small businesses in a three-way transaction that includes Fairstone Bank. Home sales and prices across Toronto saw declines last month. The Toronto Regional Real Estate Board says sales in Canada's largest city were down nearly 16% from the same time last year, dragged lower by slowing demand. The benchmark home price also fell nearly 6%. Stagnation comes as tariffs imposed by the U.S. are deterring customers from big-ticket items. And looking at the markets, bit of a bounce back for the TSX. It's up by about a quarter point right now. And looking at the markets south of the border, a new rally starting again for them. They're all in the positive right now. S&P 500 up by 0.16, Dow Jones up by nearly a half, and the NASDAQ almost a wash right now. For an investor perspective on those bank earnings, we were joined earlier by Tony Sierro, President and CIO of Caldwell Asset Management.
We were expecting that, particularly the capital markets and wealth management, where we're seeing the most growth. The other sectors, the personal banking side and loan growth, we can see that a little bit under pressure going forward. The personal banking, as banking fees come under scrutiny a little bit more, and loan growth, direct reflection of the Canadian economy. You mentioned earlier that the housing prices and costs are coming down, so loan growth will be stagnant and potentially the provision for credit losses will increase. But the capital markets and wealth management, that's the area going forward. And if you can hone in on that, you definitely have potential good growth going forward.
Sorry, Tony, I cut you off there. You refer to fees. Do you think, I mean, the budget, as you know, referred to the government's desire to improve competition in banking. Do you think the banks will be under scrutiny over the fees they charge?
I believe so. You're seeing on the investment side, fees being more transparent. So I believe something will be done on the personal banking side. And not to get into details or as far as we know, but if you see a creation of a stable coin currency that's backed by the Canadian dollar, stablecoin will make everyday banking more efficient, wiring transactions at zero cost. So things like that could put pressure on personal banking side.
The banks will resist that. People doing anything at zero cost.
Exactly. One thing I do want to mention, on the dividend yield, they increased by 6%, and that's the quarterly dividend payout. And if you factor in yesterday's price, the new yield will be about 3%. So that dividend hike of about 6% on the quarterly dividend will lead to about a 3% dividend yield. And that brings it back to within the minimum standard. If you're looking at some investors living on the dividend yield, 3% is acceptable. So that's quite positive as well for the bank. So I'm glad we saw a dividend increase of bring it back around 3% overall.
That's interesting, but it's not really much of a yield, is it, compared with some of the pipeline stocks? Or you can do better even with a name like Canadian Natural Resources. It's not that generous, 3%.
Exactly. And again, I've only secluded the investors looking at investing for dividend yield. Overall, though, you have to take the company Royal Bank in itself and its growth outlook going forward as part of the equation if you're making an investment decision. But vis-a-vis the National Bank, which increased its quarterly dividend by only 5%, we anticipated a 6% increase there as well. And that 5% dividend increase only means it still will be below 3% on the dividend yield on the stock. And that might not hit the criteria that some investors are looking for from a yield. So National Bank came out with very strong earnings this morning as well. Capital markets was an area, so was wealth management. So trending in the right direction. And earlier this year, the acquisition of Canadian Western Bank, you can see that acquisition filtering down to the bottom line as well. However, though, the dividend yield was a little bit of a disappointment. We anticipated a 6% increase. I'm not sure that will affect the stock performance today. I think it'll do well as Royal Bank, but a little bit disappointed that the yield wasn't increased a bit higher.
So you'd be inclined with new money to buy Royal Bank, but National Bank is a hold for you right now?
Yes, and there's a couple of reasons for that. Royal Bank, we like the acquisition of HSBC Canada it did last year. Now, even though HSBC is a bank in Canada, it has the global capabilities. So Royal Bank, the explicit revenues, you see them right away, so reduced costs, bringing on more revenue streams by the acquisition. But the implicit revenues that you can't see are what we anticipate going forward. That intellectual property you got from a global wealth manager will reflect down to the bottom line of Royal Bank as it enhances its scope, more of a global investing bank versus just a domestic bank. So we think those implicit reasons, intellectual property acquired vis-a-vis HSBC Bank Canada will do well going forward. Also, Royal Bank raised their profit forecast for next year, the profit targets for next year, and that's quite good to see. Royal Bank is the Canada Bank. It's the People's Bank in Canada. Our economy seems to be in a little bit of a rut, but however, Royal Bank continues to raise their target, which is pretty positive.
Give us your take, finally, Tony, if you would, on gold. What kind of a weighting are you holding in your portfolios in bullion?
On the high end, it's 5%, and the more conservative end, it's about 2%. And the reason why we're doing that, it's a direct hedge if you continue to see a weakening of the the U.S. dollar. There's all kinds of political pressure on the U.S. dollar to weaken it. You want to improve your exports and you want to buy more domestic, so you weaken your currency to do so. And gold, because it is valued in U.S. dollars, if the U.S. dollar becomes weaker, the price of gold will need to appreciate. It also is not always, but historically there has been times when you saw market volatility and the price of gold stabilize or increase. So for us, it's a way to mitigate some portfolio risk, but also to mitigate some of the political pressure of declining U.S. dollar.
And Andy was speaking to Tony Sierro, President and CIO of Caldwell Asset Management. Up next, National Bank earnings beat estimates. We'll get more reaction after the break. It's pretty much Banks Weeks here in Canada, and we're getting more earnings results along with RBC and National reporting today, and it topped earnings expectations in its fourth quarter and hiked its dividend. Let's get more now from Ernest Wong, head of research at Baskin Wealth Management. Ernest, thanks as always for joining us.
Happy to be here.
Let's talk some of the numbers. What did you see in there that you liked?
So I think going into the year for National Bank, National, compared to the other big Canadian banks, they're more focused on Quebec, so they had a little bit less worries about the housing market and some of the renewal risks that borrowers might be having. But on the flip side, the concern for National is that Quebec's economy is a little bit more focused on manufacturing, steel manufacturing, and those kinds of things. So they would be a little bit more impacted by tariff-related risks to Canada. And so I think what we're seeing for National's earnings is similar to the rest of the Canadian banking sector. Capital markets and wealth management results are really driving the strong results because of the strong increase in the stock markets this year, while the consumer and commercial banking segments are a little bit more sluggish, but being offset by strong results in the other parts of the business.
And how sluggish? Concerning or no?
I think things are fairly resilient despite kind of the headlines that you might be seeing about the Canadian economy. Loan growth is still growing. I think the impact of lower interest rates is really helping the consumer and driving, preventing loan losses in that side. And I think that what kind of the bigger story here is that in this weaker economy, consumers are kind of flocking to larger banks with scale, such as National, which is one of the reasons why I think they were able to do the acquisition of Laurentian that they completed yesterday, or that they announced yesterday.
And are we getting any more details on that buyout?
Yeah, I think it's going to work out very well for National. Laurentian had lacked the scale to be able to fully service these customers, so National will be able to come in. They're gaining a great deposit base. They're able to upsell these customers to things like wealth management services that Laurentian was not able to provide, and they've expected it to be a very revenue accretive deal for them.
And of course, with that Canadian Western, how is that working out? Or what kind of results are we seeing from that?
I think So I think from Canadian Western Bank, the integration is ongoing. I think last quarter there was a little bit of concern that as they were completing the integration process, they might lose some of the commercial customers that they had, but it seems like there's no issues on that front. I think the bulk of the capital synergies in terms of migrating the balance sheet to National's methodology, the bulks of that are going to come next year. So National is going to get a capital benefit from that. And I think that's why which gave them the confidence to raise their dividend by 5% and committing to more dividend increases through 2027 as well.
And where does this leave National compared to the other big banks?
Yeah, we've always liked National. It's our largest banking position at Baskin Wealth. We think it's a very well-run bank that has continually found ways to compete, find ways to grow their business without competing directly against the other banks, as they've done with Canadian Western Bank and as they've done with the Laurentian portfolio acquisition. And we think they'll continue to do this going forward.
And where do you see the next way that they might try and grow the bank? I mean, there doesn't seem to be many other banks around that can be bought up at this point. So what's next for them?
No, I think most of it is really around organic growth, about really completing the portfolio that they've added with Canadian Western Bank, building out the wealth management services, and building out their footprint in Western Canada that they acquired with Canadian Western Bank.
And overall, we've seen the results now from National, from Royal Bank, Scotiabank as well. How is it looking, the big picture to you?
Yeah, I think loan losses across the sector are a little bit higher due to I think in general, a weaker economy, for the weaker outlook for the Canadian economy. I think that offsetting that is obviously the strong wealth management and capital markets performance, which, I think that's really highlighting the strength of the business model that the Canadian banks have, where even if one side is weak, it is able to be offset by strength in the other portions of the business. I think on the consumer side, I think we'll probably continue to see fairly sluggish loan growth as housing prices continue to be under pressure, offset by lower rates, hopefully reducing loan loss rates going forward.
And with everything we've seen and what we might be seeing for 2026, is this enough to satisfy investors?
For the Canadian banks overall?
Yeah. Yes.
Yeah, I think so. I think that one thing about the Canadian banks is that they all, for the most part, have extremely strong balance sheets. And given their fairly cautious outlook and maybe less reinvestment potential in the business going forward, I think you are seeing large share repurchases and dividend increases. And I think the one other aspect that we didn't even talk about was the potential for the banks to use AI to lower their cost structure and improve margins as well.
Okay, tell you what, we'll steal about 30 seconds. Can you do about 30 seconds on that? What your thoughts on AI within the banks?
Right. So I think TD has talked about this, and other banks have spent considerable time talking about the potential for using AI to both improve the efficiency, lower costs within their business, as well as upgrading the technical stack that they have within their businesses. Because I think for a lot of these Canadian banks, the technology platforms that they were built on can be quite old. So really being able to use AI to upgrade it and make the business more efficient is a big opportunity for the Canadian banks.
Okay, we're going to have to leave it there, but Ernest, thanks as always for joining us.
Thank you.
Ernest Wong is head of research at Baskin Wealth Management. Coming up, Algoma Steel. The workers there are speaking out and expressing their concerns over job cuts as the company CEO blames Trump's tariff shock. Well, CTV News has been speaking with workers at Algoma Steel, getting their reaction to the CEO of Algoma saying Trump's tariff shock forced the layoffs. For more on this, we're joined by CTV's Scott Hurst.
The company and many of its workers are placing the blame on why the cuts are happening now squarely on U.S. President Donald Trump's punishing 50% tariffs on Canadian steel, an impact effectively closing off the plant's #1 customer. So in an effort to stem the losses, Algoma says the current punishing financial picture right now is forcing its hand to accelerate retooling plans. I believe we have a clip from the CEO. Let's listen to that, and I can talk more about the transformation that is happening at Algoma Steel.
I think the government certainly knows our business strategy. It knows the pivot that we had to make. It knew very well that the extreme pressure the company was under. I don't think anybody would loan the company $500 million without asking very detailed questions about what our business plan was. I think the core concern is how do we protect the ongoing Algoma Steel? How do we make sure this company is competitive, is viable? What's the technology you're going to use? How are you going to make steel? And the jobs associated with that are an output of that.
So, Andrew, in terms of this transformation, it was something, according to the CEO, that was announced in 2021 to a new modern steel-making process and platform that does require a smaller workforce, a process that is less labor-intensive. So, according to the CEO of Algoma Steel, the plant was expecting that transition to happen sometime in 2027, but with the U.S. tariffs, those plans had to be accelerated, calling it an early pivot, really saying with so few orders right now, the company had to begin the transition, and the job losses are part of that restructuring, but brought on by the punishing tariffs, with the CEO, as you heard, saying right there, Ottawa, the federal government was aware of this plan when it loaned Algoma more than $500 million earlier this year, Andrew.
CTV News has spoken with some of the workers in Sault Ste. Marie. What are they saying?
Yeah, workers, of course, right now are dealing with the initial shock. They're still reeling. Of course, it is devastating for anyone to get the notice that your job is being eliminated, and these jobs will be eliminated early next year in March. And in an interview with CTV News, union heads are saying their members are obviously upset and concerned about the ongoing layoffs. And the steelworkers, they say, had negotiated a mitigation strategy through the process to help workers transition, with the focus notably on job retraining. But now it says workers are being let go in March without that strategy being implemented. So, of course, these cuts will have a profound impact on the company, but also the region as a whole. 1,000 job losses, by far the largest employer in the region in Sault Ste. Marie. So the impact of these job losses cannot be overstated. Incredibly significant. Well, these job losses, as we mentioned, were inevitable with this retooling plan. It is years ahead of schedule, Andrew, and of course, it doesn't make it any easier.
Andy was speaking with CTV's Scott Hurst. Up next, Toronto's home sales dropped nearly 16% from the prior year. We'll talk about those numbers right after the break. Federal spending on housing is projected to drop by more than half over the next 3 years. According to the Parliamentary Budget Officer, Ottawa's spending on housing is set to decline to $4 billion in 2028-29, down from $9 billion in the current fiscal year. The decline is a result of various housing programs that will expire. The PBO notes, though, that government departments could decide to extend them. Enbridge has increased its dividend by 3% and reaffirmed its 2026 growth outlook. The Calgary-based pipeline operator says it has $8 billion worth of projects entering service next year, and it expects strong growth from recent rate settlements and cases in gas distribution and transmission. Last month, the energy company approved a $1.4 billion U.S. expansion to boost deliveries of heavy oil. And shares of TELUS are moving higher. The telecom company plans to pause its dividend growth while continuing to pay its quarterly dividend at the most recent level. TELUS says the pause will remain until its share price reflects growth prospects. The Vancouver-based company also announced a new 3-year free cash flow growth target of 10%. And taking a look at the markets, the TSX bouncing back. The banks are a mix right now, but right now the TSX itself is up about 0.3% and south of the border. New rally looks to be starting down there, although the Nasdaq's not playing nice right now, but you can see the S&P 500 up by about 1/10 point, Dow Jones up by nearly 0.5, and the Nasdaq down ever so slightly, almost a. Well, home sales are down once again in 2 of Canada's largest cities. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay, thanks as always for joining us. Yeah, these numbers not looking good for Toronto and Vancouver.
Not looking good at the moment. They are down once again. And we'll start with Toronto because these numbers are the latest to come out. And it appears that there seems to be a lot of concern around people's jobs. And that's factoring into whether they feel it's time to actually get into the housing market to buy a house. So that's interesting to see that. Obviously, the economy at play here, there's so much uncertainty. But really, when it comes to employment, that's what's keeping those numbers down. So for Toronto, activity, new listings, selling prices all down for the month of November. That's according to TREB. 5,010 homes were sold last month, which might sound like a good amount in the city of Toronto, but that's actually down more than 15% from the month of November in 2024. And if we look at month to month, there's a drop of 0.6% from the month of October. So when it comes to new listings, just over 11,000 new listings in the month of November. That's down 4% from last year. And the benchmark price of a residential composite home in Toronto is just over $951,000. So again, a lot of concern here when it comes to that kind of like long-term outlook for people's employment. We've seen, throughout the GTA, a lot of layoffs over the last couple of months, a lot of really unfortunate news. And so people are looking at that. And no movement either, too, right? People not going to other jobs. So. Well, that's just it. Yeah. And so people kind of thinking, despite the fact that there's lower borrowing costs, that prices are better, because we see that too. A lot of people who are putting their homes up for rent or for sale are lowering their prices because they're not getting that interest they're looking for. Despite all these things, a lot of people just still not feeling like it's the right time to get into the housing market. And Vancouver, really no different, isn't it? No different. A similar story, I should say, for Vancouver. Home sales were down, listings were up, but the city is on track actually for its lowest year of home sales in a quarter century. So home sales down more than 15% also in Vancouver. That's about the same number in Toronto compared to November of last year. That's apparently 20% below the seasonal average. So it's quite low in Vancouver. Month over month, though, sales were pretty stable, down about 0.1%. 2%. And the Greater Vancouver realtors say inventory remains healthy. Obviously, buyers have ample choice. That's causing those who are selling to have to adjust their prices. Just like I mentioned, what we're seeing in the GTA. You're seeing that in Vancouver as well. But again, people still just so uncertain about their future, not really wanting to get into the market at the moment. When it comes to new listings, Vancouver actually saw a 14% increase compared to November of 2024. So more homes going onto the market. That's 36% above the seasonal average. And the benchmark price for homes has come down in Vancouver. That price for all properties is down to $1.12 million.
Wow.
Still quite high, but for Vancouver, that is down quite a bit.
It's
actually pretty good for the city of
Vancouver.
All things considered for the city of Vancouver. And then for the rest of the year, it's not really expected to get much better in most of our major cities because, of course, December is a slower month when it comes to homes on the market.
Okay, Lindsay, thank you for that.
Thanks.
BNN Bloomberg's Lindsay Biscaya. And let's talk a little bit more about this in more detail, at least on Toronto's real estate market. We're joined now by Jason Mercer, Chief Information Officer at the Toronto Regional Real Estate Board. And Jason, thank you very much for joining us.
Morning.
Numbers concerning your thoughts on where they stand right now.
Well, I think a lot of what we saw with regard to sales and price especially sort of continues the trend that we've seen, throughout the fall and as we move into the winter where, while we've seen an improvement in affordability, both in terms of borrowing costs and selling price, we haven't yet seen a real movement off the sidelines on the part of buyers. And I think a lot of that just has to do with the lack of confidence in the overall economy, people waiting to see what's going to transpire in terms of our trade relationships south of the border and I would say with China as well.
And are you finding what some of the reasons? I mean, obviously the overall thing is the economy, but within the economy, are there different reasons why people are holding off?
Well, I think if you look at a diversified economy like the Greater Toronto Area, there's a lot of connections with trade south of the border. And so there's a lot of individuals that say, hey, I've seen a real improvement in affordability and all else being equal, I'd be moving off the sidelines and back into the marketplace. But, I need to take on a mortgage or a larger mortgage to make the move I want to make. And so I want to be confident that I'm going to retain my employment and ideally see my income increase over time. And I think there's a lot of households that aren't 100% convinced that's the case at this stage.
And what kind of a role is the changes in immigration that we've seen and we're starting to see? Is that a factor as well? Because I know Toronto is a destination for new Canadians.
Yeah, I think that's certainly a topic of conversation when we're thinking about first-time buyer activity. And so if you think back a couple of years ago, it wasn't only sort of traditional immigration that was driving rental demand, but also a temporary migration, and that's really ebbed. And so what you've seen is a lot more inventory in the rental market and a lot more negotiating power for renter households. And so there's less of a push from, say, the rental market and into home ownership. And so we haven't seen as much first-time buying activity as a result. And so certainly in the condo space, that's one of the factors that's led to lower sales as well.
Yeah, and let's talk about some of the different sectors. Condos first, how are they doing? I know they've been struggling. Is it the same situation now?
Yeah, I mean, if you look at that market, we have seen a real uptick in listings over the past year to year and a half. And so what's that meant is for those people who are active in that segment, they've had a lot of choice and so therefore a lot of negotiating power. And we've seen average selling prices trend lower. I mean, on the flip side of the coin, as we do see some momentum back into the market, as we move into 2026 and beyond, there'll be a lot of buyers, especially first-time buyers, that are able to negotiate a good deal relative to what we had seen, previous to interest rate tightening.
And then is it kind of a bit of a chain reaction because people aren't moving up as well, and we're not seeing movement in the more expensive homes?
Yeah, for sure. And that can also impact the listing side. Like if you have individuals that are saying, you know what, now is not the time for me to make a move, from my current home into something new. You also don't see the listings come online. So you also can't buy what's not available for sale.
And is there any good news? Like, are there any neighborhoods or pockets that are actually going against the grain on this?
Well, I think the greatest news is that we are poised for a recovery in terms of sales as we move into 2026. Like if you think about the income that would have been required to purchase the average price home in the GTA at sort of the top of the interest rate tightening cycle, that was over $200,000, which is well above the average household income in the GTA, and we've seen that come off probably by about $65,000 to $70,000, and so that really speaks to the improvement in affordability. And I think a lot of households realize that, and they have every intention on purchasing a home. They just need to see a little bit more certainty around our economic future in the GTA and Canada-wide.
And can we call this officially a buyer's market right now, or is it still in the middle?
I mean, certainly, buyers are benefiting from more choice than we've seen over the past decade, and that's certainly influenced the trend on pricing over the last few months.
And with obviously the economy stabilizing would be the big factor. Rate cuts, we may not see one. Is that still a factor, or are people getting more comfortable with the levels we're at when it comes to rates?
Yeah. I mean, I think we've seen a lot of relief on the interest rate front. I think there's a lot of households out there right now that are right on the margin of affordability, and so they could benefit from one or two more cuts. But I think on the economic front, we saw some good news over the last month where the employment numbers for October were a surprise to the upside, GDP numbers as well. But on the flip side of the coin, we had the Algoma announcement the other day, and so again, I think people are seeing sort of both positive and negative right now, and as a result are sort of standing pat. I think if we see more momentum on the positive front from an economic perspective, better news, in terms of our future trade relationships, you'll start to see an increase in home sales as a result.
And just one last question on new home construction. We didn't really get into that. How are we seeing sales there, or is that as stalled as everywhere else?
Yeah, I mean, there's a really strong correlation between the conditions that we see in the resale market and the number of people who are visiting pre-construction sales centers. And, that's both from an end user perspective. If you're up against stiff competition in the resale market, you're prepared to sacrifice some time, purchase a home off of plans for delivery down the road. Same thing as an investor. If you're looking to purchase a pre-construction home off of plans and take occupancy on ownership down the road, you want to be certain that you're going to see price increase over that period of time. And so slacker resale market conditions have led to slower sales on the new home side.
Okay, Jason, we're going to have to leave it there, but thank you very much for joining us.
You're very welcome.
Jason Mercer is Chief Information Officer of the Toronto Regional Real Estate Board. Coming up, we'll have more perspective on earnings from RBC and National Bank. Stay with us. Quick programming note for you. Know Your Options is back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. The National Bank of Canada has reported a rise in fourth quarter profit boosted by a robust performance in its wealth management segments. RBC also turned in a jump in its fourth quarter profit and hiked its dividend. Let's get perspective from Tim Riggin, Managing Director at King West & Company.
The integration of HSBC has been fabulous. In all their different markets, they're doing very well. They're increasing their business. When I say incrementally, they're doing a great job of it. So nothing really pops out in this other than the fact that they're doing great and they're a well-oiled machine, and we're happy.
My brother's an accountant in Ireland, and he was telling me yesterday that he's moved all his money from a traditional Irish bank to an online bank just to get the lower fees. Is that a threat to the established Canadian banks?
Well, if you look at it, there are different banks like EQB that's coming out with earnings later on today. That's more of a virtual bank, if you will, or an online bank. But a lot of them, if you look through it, they're going to have their mortgages, their deposit bases, but really where they're growing a lot, capital markets, wealth management, RBC, and the regular brick and mortar business won't fall off. Is it going to take some incrementally? Sure. But if there's a good online bank that they see competing with them, they'll just buy them.
Yeah. Should they be allowed to, I wonder? But that's another question. Yeah. Wealth management, what a beautiful business, though, because you get fees whether you underperform the market or not.
Yes, I mean, this is a business we're in as well, but, it's been a great year. It's been a great 3 years for wealth management. And right now, I think everybody's just sitting back and looking at year end, worried about what may happen. But it's the old adage that Wall Street climbs a wall of worry.
Yes.
And that's what we're seeing right now.
Yeah. Would you put new money to work in Royal Bank?
Yeah, absolutely. New long-term money. I mean, if people wanted to, make a pass in the next year or so, who knows? But the next 3 to 5 years, Royal Bank's just going to be the juggernaut it's always been.
Right. And it does look as though the HSBC thing was digested fairly flawlessly.
Fairly flawlessly. And then, on the other side, you're going to ask me about National Bank and Canadian Western Bank, now their portion of Laurentian. National Bank seems to be doing a great job at it, too. And National Bank is now getting the scale to make even more money.
Yeah, and then, of course, National has that deal to pick up a lot of the assets of Laurentian, but not the liabilities, the messy branches that they'd have to close, etc.
So it's a great deal for Fairstone and for National Bank.
Is it an oligopoly, banking in Canada?
Oh, we've always said it is, and if you look at it now, National Bank is part of the Big Six. You do have smaller banks, but they have to pick their niches. But, where else do you have a banking system where they earn, return on equity of 15 to 20%? That's pretty good. If it was a regulated utility, they'd move that down a lot. But, that's the price we pay for a strong banking system.
Yeah, it's interesting. Yeah, you pay for security in that sense because the return on equity would be much lower on their U.S. operations or return on capital.
U.S. return on equity cap in the banking business is 10 to 12%, which is normal.
What about EQB? Maybe we can put up a 5-year chart for EQB because that one has come down. There are some, they've had management turmoil, they had tragic death of the CEO, but there are some concerns about loan losses.
There are, and they've taken some. But as you go forward, as you can see, some of it is as well when it turns over, people were calling for, the end of the mortgage market that EQB plays in. We don't think that's happening. They're well capitalized. They're doing well as a business. And we think that going forward, you can look at it well beyond 100 in the next 2 years, well beyond.
How are you treating the market now? The problem often is when you get a small group of stocks leading the market higher, somebody like you, your prudence says, well, I don't want to have too much of my portfolio in there.
Sure. Well, right now, we've done a little selling, so our portfolios are about 10% cash. But how we look at it is you don't have to do anything right now. We feel we have great companies for the next 3 to 5 years at the right price, and we can just sit pat where we are today. And if something happens, we can ride it out. If something doesn't happen, we keep going up. I think today, being worried about the market is something that more and more investors do. And as that happens counterintuitively, that's when markets tend not to implode on us.
Because people aren't piling in other words.
Yeah, it's when everybody's piling in and everybody tells you on this show that the markets are great, buy forever, then please worry.
Right. Have you got a prediction for us for 2026? Is something coming? Is there an iceberg out there, do you think?
Oh, my crystal ball. I have to get on. Yeah, it's funny because everybody asks us what's the market going to do next year. And if I came and told you 20%, people would gasp. But if you look at the markets in any calendar year, if it's up on average 20%. If it's down on average 10%. So if I was going to tell you it's up, 20 is the best guess. Not 10, but 20. So, but I have no clue, nor does anyone else.
And he was talking with Tim Regan, Managing Director at King West & Company. After the break, we'll hear from the CEO of Flair Airline about the company's latest changes. That's next. Flair Flair Airline has had some controversy surrounding its service reliability and lack of amenities, to name a few problems, but the CEO has announced some new changes. We were joined earlier by Maciek Wilk, CEO of Flair Airlines, and we kick things off with an overview of their workforce and the size of their current fleet.
20 aircraft, all modern Boeing 737 MAXs, about 5 million passengers, flying mostly Canadian domestic, but in winter also a lot of Caribbean, Mexican, and U.S. destinations.
Right. And how many Canadian cities are you flying out? What Canadian cities are you flying out of right now?
Well, all of them, but no, and I mean all major ones. We have 4 key bases, which is Vancouver, Calgary, Edmonton, and then Toronto. But we cover also like a number of other Canadian destinations. But as I said, also connections down south, like opened only recently, flights to Mexico City from Vancouver and Toronto.
You have acknowledged that there's been service problems, lack of amenities, but you say that Flair is pulling up its socks and things are different. I know you don't want to dwell on the past problems, but what caused those?
Well, I mean, it's been a long and bumpy road, but I can honestly say that by right now we are a different company than some of the passengers might recall from the past. I'm proud to say that we are the most reliable airline in Canada in terms of on-time performance and completion factor. And this is not only me saying this. This is data coming from reliable independent sources. This is a true change that we've introduced to the company. Haven't always been like this, but certainly right now we are proud to be this most reliable carrier in Canada.
Okay, I hadn't seen that data myself. So tell us, who owns the airline now? Can you just describe who are the basic owners?
Well, this is the rather wide portfolio of Canadian and U.S. investors. Overall, Canadian investors hold about 65% of all ownership, and American investors 35%. There's been some shareholder changes this year. I'm happy to talk more about it. But right now, this is how it looks. There is no single majority owner of the airline.
Right. Now, you are doing one thing, and you just announced this. You're saying that if you pay for a carry-on bag, you can skip the line and board with ease. We all hate hanging around at the gate. Just tell us quickly how that works. It sounds attractive.
Yes, and this is a perfect timing because we're launching this just today. So the new product is called Flair Express, and it indeed allows you for a smooth and frictionless experience in the airport from the check-in till the boarding. You get priority boarding, but most importantly, you have the opportunity to skip what's creating most friction, which is sizing your bag in the metal sizer. We recognize that this is a point of friction, but actually our ambition as a company is to become the easiest airline to fly, not only financially, but also physically and emotionally. And we recognize that this is a true point of friction. So should a passenger purchase a carry-on baggage from now on, from today, there's this Flair Express product which allows them to enjoy a very smooth, uninterrupted travel.
So, in other words, sorry, I know we can't get into all the detail, but if you decide I'm going to check the bag, I'm not going to carry it onto the aircraft, you get this priority boarding.
No, if you have a carry-on, so if you have your little suitcase together with you, nobody will bother you anymore at the gate, unless you want to bring a tuba into the aircraft, which will be a problem, obviously.
Oh, I see. Okay, but you have to pay for a carry-on bag.
Yes.
Okay,
yes. This is one of the fundamentals of the business model. So indeed, but 40% of our passengers select not to fly with any carry-on, and we also need to have a product for them.
Just finally, I know you had an interesting interview at the Toronto Star, and you said that you've decided, or the company, you're not trying to emulate the European ultra low-cost carriers such as Ryanair. Just tell us briefly how your model is different.
Well, this is the major realization that we had over the last couple of years, that simply copying and pasting European ULCC model like Ryanair or Wizz Air hasn't worked in Canada and will not work in Canada out of various reasons, starting with demography and geography of the country. We recognize the fact that Canada is a enormous country in terms of its size, while populated by only 40 million passengers, and this creates all kinds of challenges. That requires a low-cost airlines like ourselves to really become a value airline and create a product that is tailor-made for this very unique market.
And he was speaking with Montchek Wilk, CEO of Flair Airlines. Market Call is coming up next. Today on the show, we have Kim Bolton, President and Portfolio Manager of Black Swan Dexteritas, his focus technology stocks. And let's take a look and see how the markets are doing right now. You can see the TSX. It's back in the green, up about a quarter point. Just some of the ones we want to keep an eye on. Of course, we're hearing about the banks. And right now, Laurentian, which had that surge yesterday, it's off. TD is off right now. Royal Bank as well. Bank of Nova Scotia reported its earnings, and National Bank reporting today. National Bank's off by almost 2% at this moment. And if we head down to Wall Street and see how things are looking down there, you can see that everybody, it's been a real up and down day for the NASDAQ. You look 1 minute, they're in the green, the next they're in the red. Right now, they're off by about 0.11%. The S&P 500, you can see it's almost a wash right now. And the Dow Jones having a better day. It is up about 0.44%. One of the things I want to talk about, can we pull copper up for a second? I was looking at it earlier. Everybody's been talking about gold and silver, and silver is still in its record territory. But copper also was seeing a bit of a surge and into record territory because of some demand right now. And we were looking at it earlier, and it was up in the record territory because rising risk of tariff-fueled squeezes is the big concern with it on the London Metal Exchange. But right now, it's trading up again today and approaching highs for the year again. So that is it for us. Thank you for watching Morning Markets. See you back here tomorrow.